Hey, welcome back. It's Nolan Mathias from Mortgage 360, and this is your mortgage rate update for January 2021. And here's what's happening in the market. Interest rates continue to go down. Variable rate discounts are continuing to increase, which means lower and lower interest rates. And we're seeing new and innovative things like 10-year products under 2%. But before we get into the details, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 10,000 subscribers. Yes, we will be paying off one person's monthly mortgage or rent payment just for subscribing to this channel. So go ahead, hit the subscribe button. The absolute uptake of this has been phenomenal. There have been so many new subscribers since we started this contest, so I suspect that we will hit 10,000 subscribers fairly soon, probably in the next 6 months, so don't forget to subscribe so you have that chance to win. Okay, so let's get into it. Let's discuss mortgage rates and where they're at for January 25th, 2021, because even as of this morning, we're seeing lenders update us with brand new interest rates and lower interest rates, including a variable rate that continues to get lower and lower and lower. So as of right now, there are two types of mortgage that we talk about. There is discounted mortgages and there is full featured mortgages. Discount mortgages come with reduced features, so reduced prepayment privileges, sometimes the inability to refinance or move to a different lender, and all sorts of different things that make it more likely for the bank to profit over the long run and therefore offer you a lower interest rate. So let's start with those discounted rates. And as of right now, the lowest interest rate in the country is the 5-year variable at 1.3%. So that is prime minus 1.15. And for a 5-year fixed, the interest rate is 1.44%. Now this is for mortgages that either have insurance, so less than 20% down, or have more than 35% down, because that gap between 20% and 35% down is the riskiest for the bank. It doesn't have insurance and it is the highest loan to value that a bank will see. So you pay a slightly higher interest rate when you're putting between 20 and 35% down. Now for between 20 and 35% down, the respective rates are for a 5-year variable rate 1.4% or prime minus 1.05, and for a 5-year fixed 1.64%. And again, those mortgages both come with what's called a bona fide sale clause. So in other words, the inability to refinance or switch to another lender if you can get a lower rate. And given the fact that variable rate discounts continue to get higher and higher and higher, and therefore variable rates continue to go down, a bona fide sale clause is probably something that I would try to avoid, because there is likely going to be an opportunity to refinance into lower rates in the next 3 to 6 months to a year. So, you pay a lower rate right now, but you could potentially be giving up a lower rate down the road. Now, as far as non-discounted, and these are full featured mortgages, so you get 15 to 20% prepayment privileges, sometimes the ability to double up, and always the ability to leave and go to a different lender if you so choose by simply paying the penalty. Well, these interest rates are as follows. So for insured mortgages and for mortgages where you're putting more than 35% down, the 5-year variable, as of this morning, in fact, it was just an hour ago where I got the update, is now at prime minus 0.95, so 1.5%. So think about this. A fully featured mortgage, all the bells and whistles, some of the best products in Canada are now priced at 1.5%. Now that is 0.2% higher than a discount mortgage, but keep in mind that on your average mortgage, a 0.2% difference in interest rates is literally just the price of a cup of coffee a week. Sometimes it's a good coffee depending on how big the mortgage is. Sometimes it's not that good of a cup of coffee. Now, as far as 5-year fixed goes, fully featured, insured, more than 35% down, the 5-year fixed is now priced at 1.69%. So because there's a difference between variable and fixed, and because you can get a slightly better variable rate than a fixed rate right now, I'm definitely a proponent of variable rates. I also have a strategy around extending your runway at low interest rates that I'll link right here that makes a variable a very, very, very good choice right now. And of course, you always pay a premium for a 5-year fixed, and you also pay a premium on the penalty on a 5-year fixed. So right now, we think variable rates are the absolute best deal in the market, and that is what the majority of our clients are taking. Now, between 20% down payment and 35% down payment, so those riskier mortgages for the banks, the interest rates are slightly higher. For a 5-year variable, it is 1.70%. For a 5-year fixed, it is priced at 1.89%. So still historically very, very good rates. If you're in that category of between 20 and 35% down, I would definitely be going with the variable rate, because I do foresee that in the future, you are going to be able to refinance into a lower rate and save a pretty significant amount of money. We have one client right now, the difference between a variable rate and a fixed rate is about $11,000 over the next 5 years, assuming that interest rates stay the same. And we fully believe that he's going to be able to refinance and get a lower rate down the road in order to get even more savings. So something to think about, especially if you're considering a fixed rate. Now, there is a 10-year rate below 2% that I definitely need to mention. This is not a mortgage that I would take myself. The reason why is because I think there's a very significant opportunity to save money with a variable rate, especially if it's 0.44% lower than the 10-year rate. But for those who are very, very risk averse, you can right now get a 10-year interest rate at 1.94%. It is locked in for the next 10 years. After 5 years, you can pay out the mortgage with a 3-month interest penalty. But keep in mind that in those first 5 years with a 10-year mortgage, your penalty is going to be pretty substantial. So any ability to switch to a lower interest rate down the road pretty much goes away. And I firmly believe that we're going to see people paying 1 to 1.1% on a normal mortgage in the next 3 to 6 months. So removing that opportunity is something that you need to be aware of if you're going for a longer term fixed mortgage. In my career, we have done 3 10-year mortgages. And I can tell you right now that all 3 of those people ended up refinancing after 5 years into lower interest rates, because you pay a pretty significant premium, in this case 0.44%, for that longer term mortgage, and they very, very rarely ever pan out into saving somebody money. So that's your mortgage update for January 25th, 2021. Hope you enjoyed it. If you did, do me that favor, hit the subscribe button, hit that notification bell, leave me your questions and comments in the comment section below, and hit that like button so more people like you can see this video. And please don't forget about our race to 10,000 subscribers, where one lucky person is going to get their monthly mortgage or rent payment paid off. Cheers, we'll see you on the next video.